Jay Farner joins us this morning, the CEO of Rocket Companies, having already joined us with Dan Gilbert on Squawk earlier today. Jay, welcome back.
Yeah, thanks for having me.
We're sort of programmed to expect debuts to have this blisteringly hot opening day. You feel good about this?
I do, yeah. I'm excited about where we've come from. The team's worked incredibly hard. And as you know, for us, with the profitability of our organization, this is more about the future. And as the guys say at Goldman Sachs, putting the puck on the ice and giving us some opportunities to make moves in the future. But the company's performing great, and I feel great about where we're at.
So describe what the puck really brings us. Is it about sort of consolidating fragmentation in the industry? Is it more about digitization, speed, macro? What do you think is the most persuasive argument?
Yeah, well, you nailed it. So the consolidation that's occurred in so many other industries really hasn't happened in the mortgage space until, of course, we've got involved. In the last few years, we've moved from 5% down to almost 9% market share gain. And the scalable nature of our platform, the partnerships that we're establishing, we see that accelerating. And so being a publicly traded company gives us opportunity to take advantage of other things that may come our way. And I'll tell you, years like this, where we're so profitable, we may even be able to offer dividends to shareholders. So a lot of exciting things we're thinking about as we watch the performance of the company.
Hi, Jay. It's Deirdre Bose on the West Coast. Nice to see you again. First, I got to say, skate to where the puck is going. That's a Canadian or Wayne Gretzky thing, not a Goldman thing, but I'll let that slide for now.
Well, we're from Detroit, so we have the Red Wings.
I just had to point that out.
Yeah, we have the Red Wings, so we like hockey too. Yeah, absolutely.
Okay, good. For the record, clear that up. Now, I heard you this morning on Squawk Box, and you were talking about how the market doesn't value you guys as a fintech company yet. What does it take to get there, and why do you think appetite for basically digitizing everything?
Yeah, so look, I think we've been around for 35 years. You know, Dan Gilbert founded the company in 1985, and we've learned over time. Although our belief is that you got to believe something to see it. But for most of the world, they kind of learn as we go. So we're new to the publicly traded markets, but the 2,500 technology folks, the 20+ years of taking this complex mortgage process, bringing it online, making it incredibly scalable. In fact, this month we're going to close 100,000 mortgages across 50 states. So we know that tech platform is there. We know how powerful it is, and we'll just continue to demonstrate that to the market, line it up with our incredible digital-first brand, and I'm very, very confident that over time you're going to see the entire market recognize the power behind Rocket Companies.
But Jay, why do you think that they didn't see that currently? What did you hear on the roadshow? Was there some pushback, especially given how many companies want to be viewed as tech companies?
Yeah, as you're talking to people, and when you're the disruptor in a space, and people are struggling to figure out who are, there's in the mortgage space and the real estate space, people are looking at a lot of different comps. There's really no one like us. People acknowledge the fact that we are the disruptor. People acknowledge the fact our technology allows us to win 10 J.D. Power Awards for origination, 7 now for servicing. But I just think we're so much different than everyone else that it might take a little while for people to kind of grab onto all of these differences. But like I mentioned before, with a $36 billion or so market cap, we love the way we've come out of the gates, and we see just upside ahead.
Jay, I know we're talking about sort of long-term growth stories, but much more near-term. We watch these weekly mortgage apps, and there's this creeping school of thought that we're running into an area where all the affordable houses have been snapped up, and we're seeing that at least the week-on-week growth rate cool down. Anything wrong with that?
Well, we have an inventory issue, right? I think COVID created some of that. Hopefully we'll see that expand. But right now, I think about 4 months worth of inventory is what we're looking at. And so it's a very competitive market. On the refinance side, you've got nearly $11 trillion of mortgage applications that should be taken, meaning $11 trillion of mortgages that are in the money. The industry has capacity for about $2.5 trillion. So there's a lot of work to be done to help American homeowners. But we see a great rush here for full approvals on the purchase side of the house. Hopeful that inventory will increase, but I think it bodes well for home prices overall because of the demand.
Finally, I noticed you mentioned a dividend. You got a timing on that?
You know, we don't. It's just this year is so amazing. And, you know, our first priority is always investing back in our company. We've been doing that for years now, as you know. Every dollar we put in to build out the technology, to build out the platform, to build out the brand has paid us back. And so that's where we look first. But when you have a year like we're experiencing now, where, you know, our current EBITDA margins are north of 70%, and we're looking at volumes going from 15 billion to now 30 billion, you can run rate that out. It's going to be an amazing year for us. And so we just want to be keeping all of our options open, and a dividend could be a real option for our shareholders.
Well, Jay, we appreciate the curtain raise, obviously, early this morning with Dan and this on the open. Congratulations again. Look forward to talking to you often, I hope.
Absolutely. Thank you very much. And thanks for having Dan as well. I know he appreciates always talking to you guys.